The Plug Power Inc. stock is currently trading at $2.92 as of 10:28 a.m. Eastern Time on October 29, 2025, reflecting an intraday gain of approximately 4.82% from its previous close of $2.79. Now, before we even address that recent bounce, which might seem like a simple relief rally after a tough stretch for the stock, the real unexpected insight here lies in the sheer volume and nature of the recent insider buying, particularly in early October when the stock was trading significantly lower near the $2.33 mark. We're not talking about a single director acquiring a token amount. We're seeing a cluster of non-open market acquisitions by multiple directors and the CEO in the first week of October. This coordinated insider activity suggests a level of internal confidence at a time when the external market narrative was overwhelmingly negative, creating a massive tension between the market's expectation of continued weakness and the company leadership's real money affirmation of value. That's the kind of subtle but critical divergence that sophisticated investors, whether they use an individual brokerage like Fidelity or a platform like Robinhood, need to pay attention to because it directly challenges the prevailing bearish sentiment. The common expectation for Plug Power is that it's a perpetually cash-burning hydrogen pure play, consistently falling short on profitability targets. This expectation is deeply entrenched, and you can see why. The company has a long history of projecting profitability only to revise those timelines. The stock's dramatic decline from its 52-week high of $4.58 speaks to this weariness. The reality, however, is far more nuanced, especially when we consider the macroeconomic landscape and the specific recent micro-catalysts. For example, the stock's volume on October 28th was substantial, nearly 90 million shares, indicating heavy institutional rotation or very active online investment. The immediate 4.82% gain today, while modest in absolute terms, is significant because it is a direct continuation of a technical rebound that started from a 52-week low of $0.69. The stock is a deeply speculative name, and its daily swings with a day range today from $2.70 to $3.05 are not for the faint of heart, but they are driven by a deeper struggle between the promise of green energy subsidies and the current cost of manufacturing that technology. The majority of the recent movement, especially the upward thrust through late September and early October, coincided with growing clarity around government tax credits, specifically related to the production of green hydrogen. And that's the core of the expectation versus reality dynamic. The market's expectation is that the path to profitability is a mirage. The reality is that major government subsidies, when finally structured and delivered, could fundamentally alter the unit economics of Plug's core products. Let's zero in on the recent trading action. The stock bottomed out near the $0.69 level, and the subsequent rally has been driven by a flurry of positive, though often incremental business announcements, and a broader, albeit volatile, surge of interest in clean energy names. The trading volume, which has frequently exceeded its 30-day average, suggests that this is not just passive buying. Institutional holdings remain substantial, with Vanguard Group Inc. and BlackRock Inc. among the largest shareholders, collectively holding hundreds of millions of shares. This concentration of institutional money, even if some is tied to index funds, adds a layer of stability and suggests long-term conviction from some major players, even as other funds may be aggressively selling or shorting. This push-pull between the fundamental believers and the short sellers who are betting on the company's inability to achieve its financial goals is what makes Plug Power stock one of the most volatile names on the NASDAQ. This is the exact kind of active market where platforms offering self-investing tools like SoFi Invest or the analytical tools available through interactive brokers become essential for investors trying to sort through the noise. The institutional activity over the most recent reported quarter, ending June 30, 2025, showed a mix. A large number of institutions increased their positions, while a significant number also decreased theirs. The key takeaway is the sheer volume of shares in motion, which signals a reevaluation of the company's prospects. The massive short interest in the stock also creates a constant upward pressure. The expectation is for a collapse, but the reality is that every bit of good news forces those short positions to cover, leading to sharp, unexpected spikes, often referred to as a short squeeze. This cyclical tension is a defining feature of Plug's stock movement. Now, for those new to the name, or perhaps using a Schwab Intelligent portfolio that has some exposure to the sector, it's important to understand what the company actually does. Plug Power is focused on the complete hydrogen ecosystem. It designs, develops, and manufactures hydrogen fuel cells and the related infrastructure for use in the mobility and stationary power markets. Its initial business was heavily concentrated on the GenDrive fuel cell systems used in material handling equipment like forklifts for major clients like Amazon and Walmart. However, their strategy has been shifting aggressively to green hydrogen production and the sale of electrolyzer systems, which use electricity to split water and produce hydrogen. They aim to be a vertically integrated provider, controlling everything from the production of green hydrogen at their own plants, like the massive Georgia facility, to the delivery and dispensing of the fuel. This vertical integration is the reality they are trying to build to counter the expectation of perpetually high fuel costs and low margins. Their revenue model is complex, incorporating equipment sales, fuel cell systems, electrolyzers, service and maintenance contracts, GenCare, and hydrogen fuel delivery, GenFuel. Historically, the core issue has been the cost of hydrogen and the high operational costs of scaling the business, resulting in consistently negative gross margins and significant cash burn, which has required constant capital raises, a major drag on the stock price, and a primary driver of the long-term bearish expectation. You can see this clearly in their financial reports, where net income has remained deeply negative. The Q2 2025 earnings report saw an earnings per share miss, but it was coupled with a revenue beat, which suggests that while the company is still losing money on the bottom line, the top-line demand for their products, particularly electrolyzers, is growing. This is a critical point. The market may be focused on the losses, but the reality is that their ability to increase revenue from key segments like electrolyzers, which tripled year over year in Q2 2025, validates their market position and the underlying demand for hydrogen infrastructure. The future outlook for Plug Power hinges entirely on executing a few key operational and strategic shifts. Their internal expectation is to achieve positive gross margins on a run-rate basis by the end of this year's Q4, and to become operating income positive by the end of 2027, with overall profitability targeted for 2028. This path is supported by Project Quantum Leap, a cost-cutting initiative, and the scaling of their green hydrogen production network. The key catalyst is the Inflation Reduction Act in the U.S., which offers substantial tax credits for green hydrogen production. The expectation has been that these credits would be difficult to access or would be watered down. The reality is that as the rules around these subsidies become clearer, the economic viability of Plug's production facilities dramatically improves. For instance, the successful deployment of their Gen Echo electrolyzer to Galp's refinery validates their large-scale commercial capabilities outside of their legacy material handling business. Furthermore, the announced partnership to manufacture renewable fuels beyond hydrogen, such as sustainable aviation fuel, shows an effort to diversify and capitalize on broader clean energy mandates. The risk, of course, remains execution and the continued need for funding. If the company misses its profitability targets again, the stock price will likely suffer a sharp correction, reinforcing the market's default negative expectation. For anyone considering invest online in this volatile space, whether through Fidelity ETFs focused on clean energy or by picking individual brokerage stocks, understanding this risk-reward is essential. The high beta of the stock means it is extremely sensitive to broader market swings and sector sentiment. The recent positive momentum suggests that the technical picture is trying to shift, with the stock moving away from oversold conditions, but the fundamental challenges are undeniable. Comment below how you weigh the long-term potential of green hydrogen against Plug Power's history of cash burn and delayed profitability. Your insight helps all of us frame the ongoing tension here. In wrapping up this analysis, the narrative around Plug Power is a powerful illustration of the friction between market skepticism and future potential.